Hi everyone. Just a quick announcement. We've got a lot of people joining us this morning, so I'm just going to give it a minute or two for the majority to arrive with us and get settled in. We will be underway very shortly. Hi everybody and good morning. Looks like we've got the majority of our delegates into the Zoom room, so I think we'll make a prompt start. So as I said, very good morning to you all, and thank you very much for joining this morning's K3 Hub CPD webinar, where we'll be covering tax obligations for business owners, a start to finish guide. For those who haven't met me before, my name's Marie, and I'm a managing director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. By way of a bit of background, K3 Hub launched in the spring of 2021, and we are proud to have over 3,000 members. The K3 Hub offers a range of CPD and training sessions, not dissimilar to today's event, and offers referral fees for certain types of work referred into our group. Just for reference, our group offers a wide range of niche advisory services, including restructuring, corporate finance, forensic accounting, R&D tax credits, and marketing services professional services firms. Just a little bit of housekeeping before we get underway. So we are recording today's session, and the webinar recording will be available on the K3 Hub and the Quantuma websites next week, just in case you wish to refer back to anything that was said. Q&A function is open, so please do feel free to ask questions as we go along. Preferences for our speakers ease that we do use the Q&A function rather than the chat, where if you do have questions, we think we'll get lots of questions today, and if we can channel them all through into the same place in the Q&A, just helps Ros stay on top of those. We may not be able to get through all of the questions, in which case we apologise in advance. We will forward them on to Ros separately for those that we don't get through, and hopefully we'll come back to you shortly thereafter. We are going to run some short polls today during the webinar. Please do participate. Your responses are anonymous, and it's great to have a little bit of interaction. We recognise that today's session is quite long, so we will be having some comfort breaks. They'll be on the sort of there or thereabouts the hour, and they'll be for about 5 minutes. Anyway, right, on to today's webinar in that case. So I'm very pleased to be able to welcome back one of our regular speakers here at the K3 Hub, Ros Martin. Ros is a consultant lecturer, and she covers all aspects of direct tax as well as SDLT. For those that regularly attend our webinars, you may recall that Ros ran our entrepreneurial themes update last year and a very popular session on commercial property taxes. You can watch a recording of both of those webinars, and in fact all of our other K3 Hub webinars on the K3 Hub and Quantuma websites. Today's session, Ros will cover business structures when starting out and through the life of the business, tax reliefs available and how they can be best maximised, acquiring business premises in a tax efficient way, and passing the business on to the next generation. Just before I hand over to Ros, just a quick word about some forthcoming K3 Hub events that I wanted to flag to you. We've got a couple of webinars coming up just before the summer break, topics including the tax opportunities that come with expanding overseas and the people aspects of M&A. You'll find further details on a registration link on the K3 Hub and Quantum website soon. And do watch your inboxes for invites, which will be on their way. I hope that you enjoyed today's session and wish you a great long bank holiday weekend. Ros, over to you.
Thank you very much, and welcome to everybody. Just to reiterate, please do feel free to ask as many questions as you want to. I will try and get through as many of those as we go along. And yeah, it's easier if you put them in the Q&A box, but I will also keep my eye on the chat box as well. So we're going to start at the very beginning, really, and sort of think about business structures and in particular, why we choose particular structures and what might motivate us to do so. In some ways, the business structure is often a bit of a random choice for people. They have a preconception about the structure that they want to use. They are often motivated by a particular view on the tax charges that are going to arise from a certain structure. And that view may or may not be one which is valid, may or may not be informed, I suppose. But obviously there are lots of different things that we need to think about, and all of those things are going to be influenced by personal circumstances and the kind of business that you've got. We all know what the choices are, but we will talk about them anyway very quickly. Obviously, somebody who wants to set up can set up as a sole trader. It's very straightforward. It's the sort of default position for somebody who thinks they might have a business idea, but they don't really know whether it's going to go anywhere. You don't have to do anything other than just get up one morning and decide that you're going to do it, although I do appreciate that that's probably not what most people do. Obviously, one of the big risks that you have with a sole trade is having unlimited liability. All of your personal assets are potentially at risk if anything goes wrong. But obviously, again, it depends on the nature of the business. Some businesses may well be able to insure against the kind of risks that arise. Again, there's often a perception as well that you are liable for business debts, sort of including tax. But I'm not entirely sure that that is necessarily the case, but we will touch on that again as we go through. If you're not going to be in business on your own, you may be looking at a partnership. And of course, one of the areas where you can limit your liability is by using a limited liability partnership, an LLP. A vanilla partnership, a normal partnership, offers no real differences over a sole trade, to be honest with you. An LLP requires a little bit more thought because it has to be registered at Companies House. And again, I know that everybody on this call will be familiar with these basics. And then, of course, we have a limited company, which again needs to be set up at Companies House. One of the questions that I get asked, not very often, but it's one of those things that sometimes people ask the question, is about community interest companies. And this is often where people are doing things which may well benefit the community that they work in and so on. They perhaps, there's a lot of, if you go online, there's a lot of information about things like community interest companies. You are very restricted in what you can take out of a community interest company. There are limits on the sort of the amount of money as a business owner that you can actually do. Now, I do know I did help a friend of mine actually set up a community interest company in the town where I live, but I have to say that there are not very many circumstances where actually it is a good idea it will. Well, not that it's not a good idea, it doesn't work very well often because of the limit on the amount of money that you can take out of the structure. So, okay, I guess at this point, we're going to have our first poll and early opportunity for audience participation. So basically, what I'm testing here is your preconceptions. If you had a client with estimated profit of, say, £50,000, what structure would you think would give the lowest tax and national insurance contribution bill assuming that all of the available profits will be taken out of the company by dividends. So I'll just give you a few seconds to answer that, just to see where we go with that. Okay, so there is a fairly even split between limited companies and sole trades. So about 47% of people think limited company, 43 think sole trade, 8% think partnership. So thank you for participating in that. What we're going to look at now is just have a look at some of those calculations, making a comparison between a sole trade and a limited company, and we'll talk about partnerships in a minute. And so what we're going to do is, with your company, we're assuming that you take salary up to the secondary threshold, and then you take dividends out above that. So you're taking the salary in order to preserve your state pension and entitlement to other contributory benefits. Obviously, with a sole trade, it doesn't matter because you're going to be taxed on it whether you take the money out or not. And there are no differences, were no accounts taken of the different costs of operating through a limited company. Now, the next few slides are, to a certain extent, just figures. So those are the figures for your sole trade, and then the equivalent figures for companies. This is probably the one that is most interesting, in that it looks at the net amount that ends up in your pocket if you are operating as a sole trader or you are operating as a company. And we can actually see that for all income levels up to 250,000, you actually pay less tax if you were a sole trader, which I think is quite an interesting argument. Now, obviously, until you get up to sort of 100,000 level, we don't start to see significant differences. But certainly now, part of that, and when I did these calculations, I was quite surprised at the outcome myself. And I sort of did a little bit of an analysis as to why the rate of tax is so different. And it's a combination of the fact that corporate tax rates have gone up, dividend tax rates went up, so that they were sort of aligned with a potential increase in national insurance contributions, whereas in fact, in reality, national insurance contributions have come down. So it does start to make sense. Now, it is, of course, possible to argue that these kind of calculations are entirely artificial, because everybody knows that the benefit of operating through a limited company is that you don't take all of the profit out of the company. So you're paying your corporation tax, but you don't pay the tax to extract the money from the company. Now, that's fair enough, but of course, not everybody has the luxury of not spending what they earn. And particularly when we're talking about lower income levels, then that is not necessarily going to be something that is going to be realistic. Obviously, bringing in other shareholders also reduces the overall liability. One of the issues that we might think about is whether there are any problems if you have family members who are shareholders. Is it a good idea? When the dividend allowance was brought in, which means that's the nil amount, the amount that you can pay on which tax is not suffered. When it first was introduced, it was £5,000. And there was sort of quite a lot of ideas saying, well, you bring your adult children in as shareholders in your limited company. And you give them £5,000 tax-free. Obviously, the dividend allowance is now a much smaller figure. But of course, you do still have availability of personal allowance and basic rate bands. And if, for example, you had children who were at university, perhaps you were funding them through their education. Obviously, you can't do this with children who are less than aged 18 because you continue to be taxed under the settlements legislation. But certainly it is a possibility. I have to say that I've always operated my business through a sole trade because I've always spent everything that I've earned. And effectively, I've never seen any particular reason for becoming a limited company. But my daughter, who is now grown up and has a daughter of her own, is thinking about going back to university. And she has approached the Bank of Mum to see whether I might fund her towards doing that. And I have thought, I wonder whether it would be worth actually setting up a limited company, transferring at least part of my business into that limited company with her as a shareholder. So, you know, it is sometimes an idea, but it obviously depends on whether or not you have got availability of you know, tax allowances. And, you know, to a certain extent, you can achieve the same savings by bringing in somebody as a partner. Although, again, if it's a vanilla partnership, it's not a limited liability partnership, they do become joint and severally liable for all of the partnership debts. So, you know, again, that may not be something that you would want to do. Obviously, there are other reasons why people might set up a particular choice. Forced by clients, and that sounds perhaps a little bit more aggressive than I meant it to sound. But you know, it may well be that the people that you are working for are only going to engage if you are a limited company. I don't think we necessarily see that as much as we did at one stage. But you know, clearly there are some circumstances where, or indeed, you know, it may well be that you know, you feel like you look like a bigger business if you're a company. I certainly think that is something that I come across quite a lot. Status in IR35, I always feel is perhaps a little bit of a red herring. Obviously, if you are self-employed, then if you're working for somebody, they may well have the responsibility of determining whether or not you really should be an employee. And the same thing now applies from an IR35 perspective. So I do still think we have people going down the road of working through limited companies because of IR35, but again, I don't know. As I've already said, risk and limited liability is a big one in terms of the possibilities that you have got to restrict your liability. Although if you are a very small business, again, there is the question as to whether limited liability is illusory, because of the fact that people that you are engaging with may well insist that you put in place personal guarantees. Corporate reliefs, if you are engaged in things like research and development, then it may well be that you're better off operating through a limited company. You know, if you want to get actually, I'll come on to that next point in a minute. So there are circumstances where that might be the case. We'll talk about some of those later on. Succession planning, again, we'll talk about some of those later on, some issues to do with that. You know, provision of benefits to people who are directors, which aren't available to people who are sole traders. Again, we'll touch on some of that as we go through. Financing is another interesting one because, of course, if you wanted to try and get external financing through things like EIS or SEIS, and again, that was something that we did talk about in one of the sessions that I did last year for entrepreneurs. So again, might want to have a look at that. If you think that you have a business that would benefit from being able to get external funding, then obviously a limited company is going to be the way to go. And I do think for a lot of people, there is that assumption that you will operate through a limited company. We've mentioned partnerships, but of course, for some time, there is the issue of corporate partnerships and whether or not you might be better off bringing in a limited company and using that as a way of diverting profits. Probably worked much better at a time when the rates of tax were much lower for companies, but corporate partnerships have always worked quite well, where you have the assets personally so that you will get the ADR if you sell them, but you shift your profits into a lower tax environment. As I say, the question is, you know, what might happen there. Actually, I think this slide is out of kilter. I'll come back to that slide in a minute, because when we're talking about mixed partnerships or corporate partnerships, we do need to be very careful about the fact that there were anti-avoidance provisions introduced in Finance Act 2013, where you have got a non-individual member of the partner. So actually, this doesn't just apply to corporate partnerships that have a corporate member. They also apply to situations where you have other non-individual members. The only one I've ever come across is had a farming partnership once that had a trust as a partnership member. Basically, if you have got too much profits allocated to your corporate member in those kind of situations, then HMRC can reallocate it back to the individual, as long as they can argue that the company is receiving money simply by virtue of the fact that the individual member of the partnership is going to get their hands on that money eventually. So, you know, again, it assumes that you are going to pay less tax, and also that it is motivated by tax avoidance. So just looking at a sort of a very simple example of where this might bite, let's just say you've got an individual who has a sole trade. They don't really want to fully incorporate, but they'd quite like to put some money into a company for the money that they don't extract from the partnership. So they set up a company. So they've got Mr. X and they set up X Limited. X is the sole shareholder of X Limited. He starts to siphon money into that company, and the partnership does not receive any contribution of value from that company. The only reason that you are allocating money to the company is because Mr. X is going to be able to access that money at some point in the future. And again, if you can show that the tax rate is less, then you would be caught. The slight wrinkle in the demonstrating that the tax rate is less is that you wouldn't look at a combination, as we did in those earlier calculations. We wouldn't look at a combination of the actual corporate tax rate and the rate of tax to extract the money. You would just look at the corporate tax rate. So that is still going to be less, which, you know, doesn't necessarily mean that you would be able to avoid it by just saying, well, it's not as beneficial as it would have done in the past. Now, what you do in terms of calculating the profits that would get reallocated to the individual is you reallocate profits above what is called the notional profit. And the notional profit is a combination of two things: return on capital at a commercial rate, although HMRC's view is that a commercial rate will typically be pretty low, unless you have got a business that is very risky. And, you know, if the company doesn't actually put any capital into the business, then obviously there is nothing there. So, you know, in the situation where we've got X and X Limited, where X Limited is effectively going to act as a shell company to collect money, then there is going to be no capital being invested. If the company does provide any services to the corporate partnership, then they would be able to charge a return for the services being provided, but you can't get a cut for services that might be provided by the individual who is also a partner. So again, if we go back to X and X Limited, then if there's no other employees, you can't say, well, X Limited is providing the services of Mr. X because he is a director of this company, because actually he's also a partner. So often when we do these calculations, we end up with a fairly small figure. So that doesn't particularly help. Also, with partnerships, we can have issues with salaried partners. Only applies where you've got a limited liability partnership, but it's really to attack situations where you are treating somebody as a partner when they are really an employee, but the reason that you are treating them as a partner is in order to avoid the employer's national insurance contributions. So this perhaps would be something that would not necessarily come up as an issue at the point at which a business was established, but might well come up as an issue when you have got, you're a bit further down the line and you've got employees and you think, well, actually, I could bring one of those employees in as a member so that I'm not going to have to pay them national insurance contributions. In order for this legislation to bite, you have to meet all 3 of the relevant conditions. At least 80% of income from the LLP comes in the form of what is called disguised salary, which would either be a fixed figure or an amount which varies, but only in relation to part of the business rather than all of the business. Member does not have significant influence over the LLP affairs, and capital contribution is less than 25% of the disguised salary that you are expecting to receive. So to summarize this, your salary is pretty much fixed. You don't have any influence over the LLP affairs and you haven't put any money into the LLP. And so all of those circumstances would mean that you might have a risk of being caught as a salaried member. Just going back to the point about foreign businesses, obviously, if you are going to trade overseas, then you might have different things driving the actual business structure. Obviously, if you are going to set up a company overseas, a partnership overseas, or whatever, then you would need to take local advice as to whether or not that is a good idea. Obviously, if you have a UK company trading overseas, then it will be subject to UK corporation tax. If you have an individual trading overseas, they are still going to be subject to tax in the UK, assuming that they remain resident here. In both of those circumstances, you have the possibility of claiming double tax relief, or there may be relief available within the terms of the double tax treaty. So if you are potentially going to be setting up overseas, then there is a lot of complexity to think about in terms of whether or not you are just going to trade through a UK entity or whether you want to set up a separate entity overseas. And really that may well depend on the entity that you are going to, or the jurisdiction in which you are going to work. And therefore, it's just one of those things that we can't really make any particularly generic comments about. Okay, so that's the sort of overall business structure. But whilst we're talking about different structures, I suppose the other thing which it's worth just looking at is that if you do set somebody up in a limited company, what is the best way to extract money from that company? Typically, you would be looking at dividend versus salary, although we will just touch on some other possible options at the end of this section. Now, I had a slightly strange way of calculating what the marginal rate of tax is for sort of a bonus or salary versus dividends. And I suppose for the avoidance of doubt, we are assuming that we are talking about the sort of a top slice of income. So we've already used our personal allowance, we've already used, dividend allowances, any of those kind of things that are available. So we are just making a strict comparison between the two options. So what I think about is that, you know, you've got a gross £100 to pay out to your individual. If you're going to pay that out as a bonus, obviously, out of that £100, you've got to pay your employer's national insurance contributions. So the gross amount of the salary that you are going to pay would actually only be £87.88. And for a basic rate taxpayer, looking at the 24-25 figures, you would have income tax of 20% and national insurance contributions of 8%, which means that out of that £100, you as the individual would get £63.28, which would give you a marginal rate of tax of 36.72%, taking account of all of the corporate tax, national insurance contributions, personal tax. Obviously, there is no corporation tax in this situation because you get a deduction for the whole of that £100, so that you would bring your corporation tax liability down to nil. If we were making a comparison with the dividend, obviously dividends are not tax deductible. So the first thing we have to do is deduct our corporation tax. And in this case, we are making an assumption that this is paying tax at the lowest rate. And then we take all of that money out as a dividend, the dividend income tax rate being 8.75%, which means that the marginal rate of tax is 26.09 as shown on the slide. The individual gets £73.91 in their pocket. And we can again look at the figures here. We can look at salary. As I said, the rate of tax on your salary, the marginal rate of tax on your salary does not vary with the different rates of corporation tax, whereas dividends, the marginal rate of tax does vary depending on the rate of corporation tax. We have the small companies rate of 19%. We have the main rate of 25%. Small companies rate obviously applying up to 50,000, main rate applying from 250, and we have the marginal rate between those limits, and the notional marginal rate is 26.5%, although if you have dividend income, it can be slightly higher than that. And I suppose, you know, you can prove anything with figures. The interesting thing in relation to that particular calculation is that you can actually see that the marginal rate of tax is higher if you are a higher rate taxpayer, where the company is paying either the main rate or indeed the marginal rate of corporation tax. And if you are an additional rate taxpayer, again, it is higher if you are a company paying the marginal rate. So it is not always that straightforward, although it does have to be acknowledged that you'd have to be paying a large amount out to your individual for it to make a significant amount of difference, because the marginal rates are not that different. Now, gosh, I've lost my train of thought then. I forgot what I was going to say. Anyway, what else can you do other than dividend or salary? One of the things that we do see quite often is situations where people don't extract all of the money out of their company because they are working on the basis that it gets paid out to them when the company is wound up or when they sell the company, and they will get business asset disposal relief on it, and therefore they will only pay 10% tax rate. I mean, obviously, there's a couple of points there. You have to hope that there is no change in the rules before you get to the point where you're going to extract the money. The other point is that there is a chance, of course, that having cash accumulated in your company means that you don't get business asset disposal relief, because HMRC are able to argue that you're no longer a trading company. No great indication really of the fact that HMRC take that argument very often. But in addition to that, there's always the question of, well, if you sell the shares in the company rather than winding the company up, how are you going to get the cash out of the company as part of the purchase deal? I mean, there are ways of doing it. If your business is being bought by another company, then they may be happy to pay you for the cash because they can then dividend it up to themselves without paying any tax on it. So again, it will depend. The other area where we are seeing issues is in relation to business property relief. So cash accumulated in companies, the revenue are getting very, very tight at the moment about this effectively being an excluded asset if you can't demonstrate it is needed for the business, and therefore you have a restriction on business property relief. Now, again, most people don't or are hopeful that they will never have to consider the BPR issues, but I have currently got an argument going with the revenue in a situation where somebody died very young, very sadly had motor neurone disease, and where they are now challenging the BPR on the company. So again, need to be a little bit careful about that. Pensions can be seen as quite a good option, but that does assume that you believe that pensions are a good, attractive option anyway. People can be very much divided as to whether or not they are happy to put money into a pension fund or whether they'd rather invest the money personally. But if you think pensions are a good idea, then getting money out of your company as a pension can be a good idea. Of course, the $64 million question is, would there ever be any problem with getting tax reliefs in relation to pension contributions? There are two aspects of this, I suppose. The first is the individual themselves. Pension contributions are always exempt from employment income. There is a specific piece of legislation which says that, makes that particular point. Obviously, if you make payments above the annual allowance for pension contributions, then there could be an annual allowance charge, although there is an ability in some circumstances to carry forward unused allowances for up to 3 years. So there can be quite a big wedge of money going into a pension at any one time. Probably the bigger issue might be whether or not the revenues say that pension contributions are not being made wholly and exclusively for the purposes of the business. Now, in reality, again, it's one of those areas where we really don't see very many challenges. But the other point is that a few years ago, the revenue also altered their guidance. So it now basically says that you don't compare the pension contribution with any salary that has been paid and see if it is excessive. What you do is you take the salary and the benefits and the pension contribution, look at it as a single package, and then decide whether or not it's excessive in the context of the work that the individual does. And so I do think that it is probably going to be the case that you would be unlucky if the revenue challenged that. I think the only situation where I might perceive there is a bit more of a risk would be if the level of pension contributions create a loss for the company, particularly if you were carrying that loss back and claiming repayment of earlier years corporation tax. That might be a trigger for the revenue to have a look at it. But even in that situation, you might be okay. But just perhaps be a little bit more circumspect in that situation than you would be otherwise. Loan interest, if you have got someone who has got a loan account in credit, then obviously there is the possibility of paying loan interest, and you can take advantage of the personal savings allowance and also the nil rate for savings income if you have no other income. And there is some planning that can be done around that. Although if you are paying loan interest to your shareholders, then you would have to deduct tax and submit a CT61 to the revenue. So again, it's one of those things where, whether it's worthwhile doing that, it will depend on the individual circumstances. Okay, I suppose the other thing to think about is the position where somebody has started off in a particular business structure and decides that they want to change that structure. And the most obvious one is where you have got somebody who decides that they want to incorporate a previously unincorporated business. And again, it's a very well-trodden path. From an income tax perspective, it's a cessation of the trade. Now, with basis period reform, there probably are not that many issues to consider from a timing perspective. Now, what I mean by that is that with effect from the 6th of April 2024, so the beginning of the current tax year, all businesses are now going to be paying tax on the profits which arise in the tax year. Now, regardless of what the actual accounting period is, which means that we're no longer going to have to be thinking about the timing of cessation, because it might trigger a huge a huge profit in the final period. So that is going to make things a little bit more straightforward. Stock, work in progress, we would normally be transferring our assets at the lower of cost or net written down value. There is an election where you have a connected party transfer where even though the default might be that the transfer is at market value, you can elect for the lower of cost or net realizable value. And most people would do that. I mean, the only situation where it might be something that you wouldn't do would be if you have got losses that you need to use up. But again, not something we would see very often. And then if you have any capital assets on which capital allowances have been claimed, again, you can sell them at the market value, but elect to transfer at the tax written down value where they are connected. It used to be that there was a lot more planning involved with capital allowances, but annual investment allowance now obviously means that you have got no residual pool to transfer other than perhaps a vehicle, a car. And so it's not really something that we would necessarily see very often in relation to these particular transactions. So if you have any capital assets within your business, then that will be a disposal for CGT purposes. It will be a connected party transaction with the consideration being market value. And you have got three basic options: sell for value. Business asset disposal relief should be available, although it's important to note that business asset disposal relief is not available on goodwill. You can create a director's loan account for the value of the assets going across. You can claim incorporation relief, where you transfer businesses into companies in exchange for shares, or you can gift assets in and claim holdover relief. Now, next poll I think we'll have here. And again, what we're saying here is that if you had a client in this position, what route are you most likely to recommend to them? in terms of planning. We are going to go through these in a little bit more detail in a moment, but just sort of, again, getting a little bit of a sense of what you might think would be the best way to go if you were advising a client to do that. Okay, incorporation relief. A few might go for holdover relief, a few might go for a sale. It's quite interesting, actually, that so many of you have suggested incorporation relief, because I would have said with my clients that is possibly the route that is considered less often, which is why it is interesting to get these polls up and ask you those questions. So thank you for that. Okay, so incorporation relief, we'll start off with that one. So incorporation relief is where you transfer all of the assets into the business, into the company. You don't have to transfer the cash, but you do have to transfer everything else in. It's transferred as a going concern, although that tends to be a given in these kind of circumstances. And you are transferring in wholly or partly in exchange for shares. So the gain is rolled over into the value of the shares. So the issue value of the shares is basically the net assets that you are transferring in. And then we reduce the base cost of those shares by the gain that is going in. Now, one of the things that it's quite important to acknowledge with incorporation relief is that if you had a business where the net asset value was quite low, for example, because there were high levels of borrowings on the business assets, then we can have situations where the gain is actually higher than the net asset value. And therefore you can't actually roll the gain into the value of the shares, in which case some of the gain would crystallize. So you do just need to check that. Now, we are going to talk about the fact that incorporation relief can be used for property businesses, and we will talk about that in a moment. And this idea that you may well have high gearing such that you can't actually roll over the whole of the gain or hold over the whole of the gain is possibly more of an issue in that situation. So we will talk about that in a moment. The other thing you have to be slightly careful about is that if there is borrowing, that you transfer the debt across and then you remortgage in the company. Because if you remortgage initially in the company and then pay that money out to the sole trader or the partnership in order for them to pay off their debts so you can transfer the assets into the company, that would actually be treated as consideration for the transfer, and therefore you would reduce the amount of relief that is available. So it is quite important when we're looking at incorporation relief that basically you've got to get it right. There is a limited ability to credit the director's loan account, because any credit to the director's loan account is consideration other than shares. And we're going to have a look at an example in a moment, and we'll look at that figure in a minute. The company acquires the assets at market value, which means that that can be beneficial if they're going to sell them. And incorporation is automatic, but can be disapplied. We have had a question in, which I will look at in a moment. But before I move off this slide, When it says that the assets are being transferred in wholly or partly in exchange for shares, the assumption is that you set up a company with subscriber shares, and then you issue more shares at the point at which the assets are transferred in. One thing I have seen in the past is people actually forgetting to issue more shares. Now, it is interesting because there is no time limit for that. And as long as it is clear at day one that you are intending to issue more shares, there can be a bit of a delay. So what you would need to do is make sure that it is documented. And what I would always recommend is a board minute. And then you have a little bit more wiggle room in terms of the shares. Okay, so the question that has been asked is actually linked to that. For incorporation relief, can the company be set up before and then the assets transferred in, say, 3 months later, when administration, like property mortgages, has been sorted out? Yes, as I said, probably what you would do in that situation. And in fact, you can claim incorporation relief into a pre-existing company. Doesn't matter when the company has been set up. But if you set up a company with subscriber shares and then transfer the assets in, when you have done the relevant admin, then that can be a possibility. I do think you need to be a little bit careful, though. I've got a client who has just undertaken has just got a query from the revenue, and they've done something which has got them into a bit of a pickle. And I'm not entirely convinced that the revenue are going to accept this, but we'll just have to see. So they've incorporated actually a property business and claimed incorporation relief. But what they've done is they've exchanged contracts, which is obviously the date of disposal for CGT purposes, into the company on the basis that incorporation relief is going to be claimed and there's no capital gains tax liability. But they've decided that they're not going to complete each of the contracts until the point at which the mortgage deals come to an end, because they've got some very good fixed rate mortgage deals at the moment. And so there's sort of going to be a 2 or 3 year process whereby, as each one comes to an end, they're going to remortgage it in the company. Now, going back to the point I was making before, they're going to have to be very careful that they don't trip up. But what has now actually happened is one of the properties has been sold. Now, the legal owner is still shown at Lands Registry as being the original owner. So the revenue have sent them a letter saying, why haven't you submitted a CGT return? Because you disposed of residential property. And so what they're now having to do is go back to the revenue and say, this was actually a partnership property, because it needs to be a partnership property for SDLT purposes, which we will cover in a minute. I know that the legal owner at Lands Registry is shown as being Mr. X, but actually it's being transferred into the company. We've claimed incorporation, or we're going to claim incorporation relief, and then the company sold it, but there's no gain for the company because they've sold it at the previous market value. So they've sort of got themselves in a bit of a mess trying to avoid having to pay high rates of interest on the remortgage of the properties. And I wasn't involved in this advice in the first place, but I think they've got it slightly wrong, to be honest with you. This is the formula that where we look at the amount of gain for which incorporation relief would be available. And it is the value of the shares that you receive divided by the total consideration. So if you had cash, or if you had a credit to your loan account, then obviously the total consideration received would be higher, and therefore the amount of gain that you could claim incorporation relief on would be limited. So again, we'll have a look at that in a minute. Now, holdover relief. You don't have to transfer all of the assets in. Holdover relief operates on an asset by asset basis. Actually, it's not only do you not have to transfer all of the assets in, but you can claim holdover relief on some assets and not on others. So holdover relief applies where you transfer as a gift, or indeed you transfer under value into a company. You hold over the gain into the asset, so the base cost is reduced. And in fact, you can pay up to the original base cost without actually triggering any gain arising, which is quite useful if you've got something like property. And you can then also create a loan account for the value of the assets that you're going to put in. Now, I'm going to talk about holdover relief as a concept and look at some of the conditions and look at some of the problems when we look at succession planning, because that is, it's an important part of succession planning. So I'm not really going to talk about it here anymore, but we will come back to this a little bit later on. But let's just have a look at an example of the sort of three options that you might have. So we've got a fairly small unincorporated business, which has got freehold property, small amount of fixtures and fittings and cash. There's trade debtors, there's stock, and there's trade creditors. And overall, the balance sheet has got a value of £167,000. But we are told that the freehold property is worth £200,000 and there is goodwill of £50,000. So the actual total value of this business is 277,000 because there's a 110,000 uplift in the balance sheet value of the assets. So as I said, we have three options here. We could sell those assets to the company. There would be a gain on the property of 60,000. There would be a gain on the goodwill of 50,000. Gain on the property would be eligible for BADR, but not on the goodwill. So the tax on the property will be £6,000 at 10%, assuming that, BADR, all of the conditions were met. We would deduct the annual exemption from the gain on the goodwill. That would be taxed at 20%. So you've got a total tax liability of 15,400. But you would bring all of those assets in at their market value. The double entry would be a credit to the loan account of £277,000. That could then be taken out without there being any additional tax to pay. So you've got an upfront tax charge, but then you've got an ability to withdraw money. If you were to gift assets, no capital gains tax as you hold the gain over, but actually you could transfer the property into the company at its base cost without triggering CGT. So you could actually create a director's loan account of £167,000 if you transferred all of the assets in, you gifted all of the assets in for no tax. Or the other option you would have would be to gift the goodwill but sell the property on the basis that you only pay BADR on the property. You'd knock the annual exemption off, so the tax would be at 5,700, and then you would have a larger amount going to the director's loan account. You would have £227,000 for a tax cost of 5,700. Now, someone has asked, what is the double entry in the company on receipt of the gift? So what you would do is you would effectively bring it in at the original base cost, or the value that you're transferring it in. The double entry would be the director's loan account. Now, if you wanted to, at that stage, to recognise the market value of the property or recognise the market value of the goodwill, then you could put in a revaluation reserve, which would obviously be non-distributable, but would then recognise the true value of those assets. So part of the double entry would definitely be the director's loan accounts. The other, if you wanted a revalue to market value, then we would have you would have the possibility of putting that through a revaluation reserve. Incorporation relief, as I've said, the gain would be rolled into the base cost of the shares. The net assets going into the company, and therefore the value of the shares being issued, would be £277,000. We would knock the gain off, so the base cost going forward for the shares would be 167,000. You could put a small amount into the director's loan account, but it would create a tax charge. And I'm sorry, I thought I'd done a calculation there, but I think from memory, if you were to put, say, 50,000 into the director's loan account, what you would then have, if we go back to that formula that we were looking at earlier on, what you would then have is the gains of 110,000 multiplied by the value of the shares, which would still be 277,000 less the 50,000 divided by 277,000. So I think what it turns out is that your gain is about £19,000 that you would bring into charge. So there is the possibility of bringing a little bit in, but actually not a great deal is going to help you there. So it's just a case of doing those calculations. Sorry, I should say actually with incorporation relief, the double entry would be a revaluation reserve or a non-distributable reserve of some description. And somebody's asked me the question that I always dread being asked. What rate would the gain be taxed on in that case? So if we are saying you could put a credit to the director's loan account and crystallize some of the gain, the reason I dread being asked that question is that however hard I've looked, I can't actually find a definitive answer to that question. Now, and so going just to explain what the question is really. So the gain is arising on property, which would be eligible for BADR, and goodwill, which would not be eligible for BADR. And so we crystallize a gain. Do we argue that that relates to the property, or do we argue it relates to the goodwill? I suspect if you were in that situation, that you would pro rata the gain between the different types of assets and then apply the rate of tax, again, deducting the annual exemption from whichever gain is taxed at the high rate, although the annual exemption being only £3,000 now is not necessarily very helpful. But there is no reference I can find to anywhere as to actually how you would deal with that in practice. Now, just to wrap this section, this particular bit up, my own experience of this kind of incorporation is that most clients do not want to accelerate a tax charge. Even if it means that they get some value into a director's loan account, they probably won't want to accelerate the tax charge. So typically you will be planning this around how do we do this without there being any tax due at all? Okay, so it is 3 minutes past 10, so we have now got through to the end of our first hour. So I think there would actually be a really good place to stop and have a coffee break. As I say, it's about 3 minutes past. It's probably going to be 4 minutes past by the time I finish. It's 4 minutes past. So let's come back about 10 past. So I will see you shortly. But if you do have any questions, do feel free to pop those into the chat box. Okay, let's get started again. And just to note that the presentation has just been loaded up into the chat box if you want to download it. Okay, so obviously one of the things that we talk about is incorporation of property businesses. And there is a push, I suppose, at the moment to get property businesses into limited companies. Now, one of the motivations for that is because interest rates have gone up, which means that the fact that if you have residential property, you only get a tax reducer if you're operating as an unincorporated business, means that people have started to turn towards incorporation again. And of course, the potential for the furnished holiday let provisions to be abolished next year is also going to make that worse. Now, holdover relief only applies to trades, but incorporation relief applies to businesses. Now, if you have got a big enough property portfolio that you can argue it is actually a business, then you can claim incorporation relief. And there was a case involving a lady called Mrs. Ramsey, which I know I've talked about before. But that is not always terribly helpful, to be perfectly honest. And there is also the possibility of having to argue that it is a partnership in order to be able to claim SDLT liability, relief from SDLT. So incorporating property businesses in a way which is tax effective can really be quite difficult. We've already talked about the fact that you can have problems where you have property that's very highly geared. I was advising somebody recently where the borrowings were huge and the gains on the property were also quite big for various reasons because they'd remortgaged. And so the gains could not be held over for that reason. What this means is that we're actually seeing quite a lot of sort of tax planning schemes going around in relation to incorporation. So could we have the next poll, please? So what I'm quite interested to find out really just from my own perspective is whether you have got clients who've come to you with tax planning ideas for incorporation of property businesses, where we're not talking about kind of standard property incorporation, but where we're talking about more, perhaps more exotic ideas. Okay, so about nearly 40% of you have had those kind of ideas given to you, which is quite interesting, though not a huge, not necessarily a huge number in absolute terms. Just want to mention something very quickly, really, is that HMRC are focusing on this particular area, and as part of that, they have issued a spotlight. Now, spotlights are where the revenue are effectively saying, we've come across this scheme and we don't think it works. Now, the idea here is that, and this is the scheme that the revenue outline, is that basically you set up a corporate partnership. You have an individual, you have a company in an LLP, the individual transfers their property into the LLP, and then they make various claims about the finance costs continuing to be deductible. They also say that there is an uplift in market value to the base cost of the properties, that you can still get a full deduction for the finance costs, that the corporate member will pay less tax, although as we've seen, that's not necessarily the case, and that BPR is available on this structure, even though BPR is not typically available on investments. The revenues view is that the mixed partnership rules that we've already talked about would attack this structure, which I would agree with. They also suggest it might be caught by other anti-avoidance provisions. They don't agree that there is a tax-free uplift to the market value, and they don't consider that it gets BPR. So this is actually one that is quite straightforward in some ways, but where the claims for the promoters of this scheme do not really chime with the position that the revenue agree. The revenue have said in this spotlight that they will help clients get out of this if they have got into it and are already committed. There are also issues to do with mortgages, and they make no reference of SDLT, although I'm quite sure that there is an SDLT issue here. And this is actually the most vanilla of the schemes that I've come across. I have had exposure to another couple of schemes which are much, much more contrived than this one. And I wouldn't be surprised if we don't see spotlights to do with them in due course. I suppose the bottom line is that I'm sure that there are legitimate things that can be done, but most of this sort of schemes, in inverted commas, that I've seen just don't work in my view. I went to a meeting with one of the promoters for one of these schemes, and they kept saying to me, well, we've got barrister's opinion that this works. And so I said, would they be happy for me to see the barrister's opinion? And they said, oh, absolutely fine. We've got nothing to hide. And then I contacted them a couple of days later and said, oh, I think that you were supposed to be sending me this barrister's opinion. And they said to me, we can't find it. We've definitely got it. And they were definitely happy. But we seem to have misfiled it, which to me was slightly worrying, apart from anything else. Okay, so that was just a little bit of a byway, really, about these property businesses. The other thing I just wanted to talk about is disincorporation. So we've talked about what happens when you move a business from a sole trader into a limited company. It may well be that you have got people who want to go the other way, want to move their company assets back into a sole tradership, and again, if they don't perceive that there are any advantages in being a company, then that might not be very helpful. Now, we used to have something called disincorporation relief, but that was actually abolished in 2018, and it was abolished because HMRC put out a press release saying, we're thinking of abolishing this, is anybody bothered? And nobody answered, so they abolished it. To be honest with you, I think probably the reason why people weren't really that bothered about it was that it wasn't terribly helpful anyway. So, we don't need to think about that anymore. But effectively, if you do move your assets from the company to the individual, not terribly helpful. Obviously, the company will be ceasing trading. Again, the cessation of the trade is in itself not particularly problematic. But the company will be disposing of the assets at market value. There will be a disposal if there are any capital assets. And so obviously the tax cost, it will depend on what the base cost of those assets are. It will then be a distribution in specie of the assets and any distributable reserves to the shareholders. And again, that would be at market value in relation to the assets. Now, obviously, you could distribute these assets as a distribution in specie, would be income tax liabilities. If you could do it as part of a formal winding up, so you effectively wind up the company and distribute them as a capital distribution, then obviously there is the possibility it could be taxed as capital and you could get business asset disposal relief on it. But you have to be really careful because there is a targeted anti-avoidance rule. Now, if you are caught by this TAR, there is often a misconception about the operation of this piece of legislation. A lot of people seem to think that if you are caught by this, you would lose your business asset disposal relief, but actually it's a more fundamental problem than that. If you are caught by this, then it becomes an income distribution, even if it's done as part of a winding up. So you could end up, instead of paying 10% tax, you could end up paying 39.35% if you're an additional rate taxpayer and it is an income distribution. So the targeted anti-avoidance provision applies where four conditions are met. Company is wound up. Shareholder owns at least 5% of the shares. The recipient of the assets, or the shareholder, I should say, then carries on the same trade or business within 2 years following the date of the distribution. And it is important to note that that could be in any structure, and it is tax motivated. So you're normally going to be able to tell whether the company is being wound up. You're normally going to be fairly straightforward that they own at least 5% of the shares. Same trade or business is a matter of fact, but the revenue obviously take quite a wide view on whether or not it's the same trade or business. And as I say, it could be a sole trade, it could be a partnership, it could be another company. It could also apply if you are an employee, if you are only an employee because you are trying to circumvent the legislation. So if I had a limited company, we've already found out that I haven't. But if I had a limited company and I wanted to wind it up, and I got my husband to set up a company and I went to work as an employee, then that will be caught here. And then whether or not it is tax motivated is again going to be a matter of fact. So we haven't really had a lot of, I mean, this was introduced in 2016, and you would think probably at that stage that we ought to have started to see some inquiries or some litigation on this particular point yet. But, you know, again, it could well be problematic. Somebody said client wants to move from limited company to sole trade and just put the company into dormant status. Are there any pitfalls or issues to consider here? It's a very good question, actually, and I was going to go on and say, obviously, this issue with disincorporation, you know, in terms of the tax charges when you get the assets out, the targeted anti-avoidance if you are winding up and wanting to get the assets out, assumes that you have assets which are subject to tax in any way. I mean, if you are, you know, a company that has, you know, no business premises, not any particular goodwill, simply wants to stop trading through a limited company and start trading through a sole trade, then there shouldn't be any issue with that. But I suppose, you know, that is the point, isn't it? Are you sure that there is no goodwill associated with this business? Are we certain that nothing is being transferred out of the company into the sole trader? And so I think that's what you would probably have to be very careful about in that scenario, is making sure that there really was nothing moving out from one to the other. So this is very definitely something that we need to be concerned about. There's not a great deal of guidance on it. It is something that can cause can be quite problematic. Okay, I've had a question come into the chat. Is BADR available on the sale of a pharmacy business? Client got HMRC clearance. Property portfolio, £7 million with A shares were issued, and goodwill on the pharmacy business of 1.165 million for the B shares to the shareholders. Then the pharmacy business was sold by transferring the goodwill into a holding company in return for share values 1.26 million in the holding company. I'm not entirely clear from that question what it is that is being sold. So you've got the goodwill from the pharmacy business in the holding company. you've got a property portfolio and goodwill and the pharmacy business in the company. If you've got a property portfolio and a pharmacy business where the property portfolio is worth 7 million and the pharmacy business is 1.165 million, I can't see that that is going to be a trading company for BADR purposes. But I may well have misunderstood that question. If you want to just pop any additional questions into the chat box, I will deal with them at some point. Okay, when we are talking about businesses and tax liability, obviously one of the key issues is making sure that we advise clients as far as we can about legitimately minimizing our tax liability, and thinking about the reliefs that might be available. I have to say that when I came to write this bit of the lecture, I did slightly regret the fact that I had put this down as one of the bullet points in terms of maximising your reliefs, because of course every business is different and every situation can't be covered here. And some of the things have been covered either already in this session or in other sessions before. So I suppose I just decided that I would pick out one or two bits and pieces. Now, the obvious one is if you're a company, something like R&D. And as Marie mentioned right at the beginning of this session, obviously, the K3 have got an offering in relation to R&D relief. And actually, I do think it is quite important to make sure that you do take specialist advice in this area. It is something that the revenue are very clearly tightening up on. Now, obviously, that doesn't necessarily mean that you would want to discourage people who have got genuine claims for relief, but there has been a tightening up on the administration, the amount of information that has to be provided, all of those kind of things. Means that it is quite important to make sure that you do have, a good handle. It's in terms of the actual, what qualifies as R&D, what kind of areas the revenue are looking at, and I do definitely think that it is, something that you need to get specialist advice from. Companies, things like land remediation relief, where you have got derelict or contaminated land which you are rectifying, you can get an enhanced deduction for the costs of this. I recently did some planning for a property developer, where actually the question that had been asked of me was whether or not if they had Japanese knotweed on the land, they could get any sort of enhancement costs for removing it. And then we went through and we did quite a big exercise on some of the other things that they were doing, and managed to claim quite a high level of land remediation relief, which was quite an interesting one. Obviously, if we're talking about, as I said, there are, what sort of reliefs can we talk about? Pension contributions. We've touched on this already. Pension contributions strike me as being a really, really nice way of getting value out of your company. And we've talked about, the limitations. How high can you go in terms of justifying, holding exclusively for the purposes of the business? Company paying for remuneration planning for employees. I mean, anything that you do in terms of, enhanced benefit for your employees, efficient for employees. But of course, actually, one of the main reasons to mention this is that we are still seeing lots of schemes going around involving things like remuneration trusts, saying that they don't fall within the disguised remuneration provisions, when they pretty clearly do. So again, I think we need to be very careful with these kind of things. I think the other area where I wanted to just perhaps talk about pitfalls, maximising relief, but also making sure that you don't fall foul of particular provisions. Obviously, the difference between capital and revenue expenditure can be very important, particularly if you have got property being held. You know, if you refurbish that property, what is going to mean that the revenue will argue that that is capital expenditure rather than revenue. Now, obviously, in some circumstances, you will be able to get capital allowances, but there is also a lot of work that is done where you don't get capital allowances if the expenditure is capital in nature. You know, so if you're putting up walls, knocking down walls, you know, doing structural stuff, it may well be that you're not going to get a deduction. And until you actually sell the property. And if that is a long-term thing, then, you know, it may well be that the tax relief is a long way down the line. I mean, in very broad terms, you know, expenditure is capital, either if you are replacing an entirety or if you are in some way improving or enhancing the asset. And the question I always like to ask is, well, is the asset different afterwards than it was before? And, you know, not different just in the way that it's been redecorated or, you know, it's slightly shinier and newer. Does it have additional facilities? Have you done something that's changed an asset? All of those things can determine capital versus revenue. And it is an area where the revenue do ask a lot of questions, you know, and it is important to make sure that you do. I mean, if you can get involved before clients start doing this kind of work, so that you can get them to take photos of what they're doing, you can get full analysis of all of the work that's been done and so on. You know, all well and good, because that gives you the possibility of maximising the amount of relief that you're going to get. Don't forget that if you have got a building and there is work being done on that building where it is going to be capital and where you're not going to get capital allowances, don't forget that you have got structures and buildings allowance. If you are buying properties, don't forget that you have the possibility of getting capital allowances on integral features. We talked about this in one of the commercial property updates that I did last year, making sure that you go through the process and you know, are claiming all of the capital allowances that you can claim. That is really important. The other area that I know I have mentioned before, but which people really do seem to have a bit of a black hole about, is leasehold improvements. If you own the property personally, and we're going to talk about property ownership in a moment, if you own a property personally and your limited company trades through that property, but there is not a formal lease in place, but the company then undertakes work, particularly work on which capital allowances might be due, then they are not going to be able to claim the capital allowances because they do not have a relevant interest in the underlying property. And the landlord is not going to be able to claim capital allowances on it because they haven't incurred the expenditure. And they also would not be able to claim any deduction for it in the event that the property is sold in the future. So there's sort of a loose relationship between the different parties is one that you really do need to think about. And that does bring us very neatly onto the question of, you know, if you're talking about a business owning a property, you know, how should that property be held? Is it going to actually be an investment? You know, might be being used currently for the business, but in the future you might sell the business and retain the property as an investment. Part of the business itself, such that if you ever sell the business, it will go with them as well. Or are there any longer term planning structures associated with the building. You know, are you buying it now to use in your business, but have an eye in the future to the fact it might be developed, it might have alternative uses, all of those kind of things. I mean, with a commercial property, you have exactly the same options as you do with residential property. There isn't quite so much of a impediment to holding it personally, because you don't have the interest restriction that you do with residential property. Obviously, if you have got property, then you will come into MTD in 2026. If the income is more than £50,000 a year, that's going down to 30,000 the year after. Obviously, if you have other property, then you know it may be part of a bigger business, which might cause problem with borrowings. Loss relief perhaps less flexibly. Obviously, we've talked about the fact that there will be some tax savings if you operate through a company, particularly if you're not extracting the money, and theoretically the property can be used more flexibly. If we're talking about it really being part of the business, an intrinsic part of the business, I mean, as a sole trader, any asset that you hold is automatically an asset of the business. If you've got a partnership, then it could be held outside the partnership. It could be a partnership asset, or it could be a partnership asset where the capital value is ring-fenced by one or more of the partners. If it was a company, again, it could be inside or outside of the partnership of the company. Sometimes we also see situations where you might think about something like the pension fund buying it. I do think that there can be issues with pension funds buying property because of the financing, because there is a limit to what, you know, a standard SIPP can borrow in order to buy a property. And somebody was saying to me last year that they are finding that from a very practical perspective, they are getting difficulty getting financing for pension funds to buy property. So I don't know whether that's true, because that's not something that I've ever done. If you have already got, say, a property within a company, then you might want to think about doing an in-specie pension contribution, although you have to be careful, because if the value of the property exceeds the amount available for, say, annual allowance, if you've got an individual shareholder, an individual employee is going to benefit. But the revenue are not entirely convinced that in-specie pension contributions are able to be made from a legal perspective. And so there is a particular process that has to be undertaken in order for a pension contribution to be deductible if it is an in-specie contribution. So it is not always very straightforward. We'll come back to SIPPs in a moment. I suppose if we're talking about, you know, how you hold a property that you are using for the purposes of the business, then the first thing to think about is whether you want to separate the trade and the property. One issue that I get asked a lot about is, you know, we've got a company that's got a business premises and has got a trade in it. I want to separate the property away from the trade in case there are any liability issues within the trade. You know, effectively that has got to be something that you would think about. You could achieve that by having a group structure. So, you know, effectively, you have a holding company owning the property, you have the trade in a separate group, or you have a holding company with the property and the trade in separate companies. So, you know, again, that's something that can be dealt with relatively easily. The other thing is, you know, do you want to retain the property following the sale of the business itself? And that's why I think the longer term planning in relation to the business is really, and think about what might happen going forward is quite important. I think the difficulty is that when you're thinking about buying a property, often the money that you want to use to buy that property is in the company. And so if you want to buy it personally, you have got to extract the money from the company, and therefore you have that additional tax charge. The problem is, of course, that if you have it within the company and then somebody comes along and says that they want to buy the company, but for example, they don't want to buy the property, you are then faced with a potential significant tax charge in terms of effectively having to get the property out, be an income distribution, it will be disposed in the company. If you've got time, you could perhaps create a group structure at that point and then sell the shares of the trading company. But again, that then means that the money is trapped from the sale of the company, is trapped in the holding company. So if you are thinking that in the future you might well want to retain the property after the business is being sold, then having them in the same position may well be ill-conceived. But obviously the other point to note is that if you hold the property outside of a company, outside of a partnership, then you are only eligible for 50% business property relief, for example. Although if you are assuming that you are going to sell the business and keep the property, that may not be an issue. If you are holding property outside of the business, obviously there's the question about rent. If it is a partnership business and you pay rent, then the rent is actually going to be part of the profit share. So it's just going to be it's just going to be an allocation of the profit. If it's a company, then obviously the rent is taxable. And we've already talked about the fact that there is an issue with the incurring of costs and so on. And again, that can be quite difficult. The other thing, of course, is that if you are paying rent, then you are going to restrict the availability of business asset disposal relief if that property is ever sold. That doesn't affect the BPR, although, as we've said, you only get 50% BPR anyway. But again, it's one of those areas where in reality it is incredibly difficult to know what the right answer is, because, as I say, every situation is going to be different. Everyone is going to be there are going to be different aspects of different options available, and every client is different. But again, it is a fairly common problem if you do have property and business within the same structure, say within a company. It is a common problem to find that individuals are looking to sell the business but not looking to sell the property, and then end up with significant tax liabilities. But you can't necessarily second guess that, because it may well be that you want to sell the business premises but the purchaser can't afford to buy them. So it may well be that that decision is motivated by something else. Now, you could have two separate standalone companies, one owning the property, one owning the trade. The slight problem with that is that the property owning company would be a close investment holding company. If its only property is rented out to a connected party, which means that regardless of its level of profit, it will always pay tax at the main rate of corporation tax, 25%, but it is still taken into account as an associated company for the purposes of the rate of tax. Actually, I should have mentioned right at the beginning when I was talking about companies and business structures and so on, that there are currently issues with regard to people who have set up a number of companies at a point in time when it didn't make any difference to the rate of tax that you paid, because associated companies, or we only had a single rate of tax. I have got a private client who is a property investor, and he has a structure where he has a main holding company, and then he puts each property into a separate company. And he currently has 17 companies. It's doing very well, but it's not, and he's done that because of financing options. But now is really struggling because of the amount of corporation tax paid, because each of these companies is making very little profit, mainly due to the high levels of gearing, but it's all being taxed to 25% because he's got so many associated companies. So, you know, that has been something that we have encountered as a bit of a problem in relation to that. And we've talked about SIPs already, not necessarily being very straightforward. Okay, succession planning. Again, quite a lot to get through in this particular section in relation to different options going forward. And I suppose, again, as with, sorry, before I just mention that comment come in, client holds business premises personally, trading company does not pay any rent, partly as other personal income, so already paying high rate tax. Are there any IHT issues? Well, the IHT position would be that there would be 50% business property relief on the property. So that would need to be factored in relation to when you're doing any IHT planning. So yeah, that would be the only issue, I think. Yeah. And somebody's put SIP ? I do apologize, self-invested pension plan. I didn't touch on that any further because I had already covered most of it. Okay, succession planning. This covers quite a big area. It's a very large umbrella in terms of different areas. And once again, I think the problem that we have is that it's quite difficult to plan until you have, or unless you have, a pretty good idea as to who your potential successors might be. So if we could have the next poll up, please, that would be quite useful. Thinking about your client base, do you think they are thinking about succession planning? And if so, who might succeed them? Not thinking about it, family, staff, probably selling it, or other options. So again, really just getting a sense of where you might be going with any of these things. Okay, so there's around 16% not thinking about it, 43% probably family, 11% staff, 26% sale, other. Okay, so there are quite a few people perhaps thinking of moving on to family and so on. Okay, that's interesting. We will look at that. Okay, so when we look at succession planning, as I say, we're talking about family. If you are looking at passing on to family, You have options of giving in lifetime. In that case, you might need to think about capital gains tax liability, then maybe IHT if you die within 7 years. Obviously, if you are going to pass on in death, then you would have to consider IHT reliefs. If you're thinking about employees, then the big issue is how do you avoid upfront tax charges? Can you identify an obvious successor? Obviously, selling and so on is something that we need to think about as well. Someone mentioned setting up FICs at family investment companies. Actually, that is a very good point. I will talk about that. Let's just have a think about where it might be. Actually, yes, I will talk about that at the end of the section about passing it on to your family members, because actually that was something I hadn't thought about. Now, in terms of family and giving in lifetime or giving on death, I think that there are some fascinating conversations get had within families about, you know, the point in time at which you have someone wanting to take over the mantle of a business. You know, do you do it at a point that is relatively early? I was having a conversation with one of my accountants yesterday. He's having a conversation with someone who is 69, is talking about selling. Actually, they're talking about selling to their employees, but they're talking about selling 10% now, and then maybe 10% in another couple of years' time, and then 10% in another couple of years' time. And he was saying, you know, he should be retiring. And I appreciate not everybody wants to retire. It's just me. But, you know, again, I think it's just one of those things that it can be quite difficult. In general terms, if we're talking about giving in lifetime, we're back to holdover relief, which we've already looked at. And certainly holdover relief is a way of getting assets, businesses down into the generations without any CGT arising. Now, this is where we need to think about those assets which are going to qualify. When we were talking about incorporation relief, there was an assumption that, you know, you are effectively transferring a business which will qualify. If you're talking about a company, it's got to be a trading company, and we will have a look at what that definition is. It's not going to be possible to do that with investment businesses. Now, this is, you know, one of the issues that we do have with giving in lifetime, and this is where family investment companies do come in, and I will touch on those a little bit later on, as I've said. One of the ways in which you can get value into the hands of your children, if you don't have the possibility of claiming holdover relief, is to use something like growth shares. So you effectively issue them with a new class of shares which don't currently have any value, but which grow in value going forward. And if you structure it right, you can effectively freeze the value of the parents' shares now, so that they don't grow in value at all, and all of the growth goes into the children's shares. And again, that is something that the revenue do accept works in general terms, but it's not always that straightforward to structure it, and I'll come back to that when I talk about FICs in a moment. So broadly, holdover relief is available where you make a disposal otherwise than at arm's length, and we've talked about that already. You can't gift shares to a company and claim holdover relief. You have to do a share for share exchange if you're going to do that. And you have to make a joint claim unless you are transferring into a trust. And there is a time limit for making that claim. So one of the big issues that we have with holdover relief is situations where you have got assets that are not used for the purposes of the trade, either not used throughout a period of ownership or not used for trading purposes. Now, that would be unincorporated business assets. And therefore, that's not shares. We'll talk about shares in a second. But certainly, if you are looking at transferring unincorporated businesses, then you would have to consider whether or not there is any restriction. There's a very interesting planning opportunity in relation to holdover relief. Even though for unincorporated businesses, there is the possibility that, you have to be conducting a business in relation to the assets that you're transferring. There is a carve out, which means that you can also get holdover relief in relation to any assets on which agricultural property relief is available. And anybody who knows anything about agricultural property relief will know that you can get it on rented property, as long as the person that you are renting to, the tenant, is using it for the purposes of agriculture. Now, what this means is that, it's fairly straightforward in its situations, but where you have got APR being claimed or holdover relief being claimed because of APR availability, you don't apportion it where you have got non-trade or non-rented use of the property, as long as the it's less than half of the area of the property. And so if you have, and this is sort of planning that is often used in sort of trading or other types of of farming or landed estate type businesses. So if you have got acreage of agricultural land which is covered by APR, and on that land you have, say, cottages which are rented out, or you have barns which are used for the purposes of your business, you can transfer those properties along with agricultural land and claim holdover relief, even though those cottages might be rented out. So it is quite an interesting way of planning if you have got farms or landed estates or similar things. Now, I appreciate that's a fairly niche part of a client portfolio, but it does give you some interesting ideas. When we're talking about company shares, if the company holds non-business assets, then again, there can be a restriction on the holdover relief. And the thing that I often identify in these cases is that this is different from the restriction on BPR. Now, we haven't talked about BPR yet, and this is going off perhaps a little bit of a tangent. But if you've got a trading company that has got a rental property in it, as long as that rental property is worth less than half of the value of the company, then you won't have a restriction on BPR because they are both business assets. But if that was a company where you wanted to transfer the shares, then that investment property would be a non-business asset, and therefore you would not get full holdover relief. So it's really, there are some nuances involved in holdover relief, which can be used for planning purposes, which can make it quite difficult. The question that has been asked, does the gift of furnished holiday let qualify for holdover relief? Well, the answer to that question is it does currently. Furnished holiday let property is one of the things which does qualify for holdover relief. Furnished holiday let treatment is going to disappear, or special treatment for furnished holiday let treatment property is going to disappear from next April, as far as we know. And it is likely, or we are assuming, that holdover relief will also disappear. The other thing with furnished holiday let property is that it is more common I think, to find with furnished holiday let property that you will have periods of time when the asset has not been used for furnished holiday let. Not inevitably, because you might have bought it and started renting it out as an FHL immediately. But if, for example, you've had a property that you've rented out on a long-term basis for part of the time, and then you've turned it into a furnished holiday let property as a way of earning more money, then you wouldn't get full holdover relief in that situation, because obviously the asset has not been used for those purposes entirely through the period of ownership. One further thing to mention about holdover relief, another restriction, it doesn't work if the person that you are transferring the asset to is not resident, or indeed if that person becomes non-resident in the 6 years from the end of the tax year in which the transfer took place, unless they're actually leaving and coming back within 3 years. There is an exception if the asset is an interest in UK land, because obviously UK land is still subject to tax in the UK, even for non-residents. And so, again, you need to be slightly careful. Again, the reason I mention this is because, you know, if, for example, you have got someone who's got shares in a limited company, they're starting to think about succession planning, they're starting to think about gifting shares to their kids, they want to be equitable between those children, but it turns out one of those children lives abroad, then you are going to have a problem, because there is going to be a CGT liability in relation to the transfer of those shares. It's not just going to be family members, actually. I had a case involving an offshore employee, which I'll talk about in a moment. So again, you've just got to be very careful when we're talking about families, how this actually works in practice. Okay, well, that's quite a convenient place to stop, and it is 2 minutes past 11. So again, I will come online just before 10 past, so we'll have about 7 minutes or so. So I will see you shortly. Okay then, so let's get started again. Now, holdover relief's all well and good. Yeah, as I say, holdover relief is all well and good. But what about a situation where actually the departing family members need to get some money out of the company? In that situation, what we might sometimes think about is purchase of own shares. It's a very, very useful way to enable value to be extracted from a company. Obviously, the default position for a purchase of own shares is that it is an income distribution, but it can be treated as a capital distribution if you meet certain conditions. And there are also corporate law provisions that need to be met as well. And obviously, it is incredibly important to make sure that you check that all of the conditions are met. Now, if you've just got, say, your mum and dad with shares in the company, then obviously purchase of own shares isn't going to work, because you've got to end up with some shareholders in the company. And so what you might have to do is do a holdover relief transfer first, and then do a purchase of own shares. But obviously that would be something that would need to be taken into account depending on what the individual circumstances are. So shareholder must be resident in the UK, although if they're not resident in the UK, then you would just need to consider what the tax treatment was in the jurisdiction in which they were resident. They must have owned the shares for more than 5 years, and it is quite important that this is non-negotiable. Now, if you had a spouse or civil partner where one transferred the other shares to the other, then you do take account of a period when it was held by the transferor, or if it's inherited, it's only 3 years, and you can take account of the period of ownership of the deceased as long as it is the spouse or civil partner. But again, you just need to be very careful to make sure that you meet those conditions. It's got to be an unquoted trading company, and the definition is wholly or mainly trading, so that is 5149. So it's actually a lower bar than business asset disposal relief, because BADR you need at least 80% trading. So there could be situations where you can get purchase of own shares, but you wouldn't get BADR on it. So again, just to be aware of the fact that those two things are not necessarily, aligned. The vendor must substantially reduce their shareholding. So they've got to reduce it to less than 75% of what they held before, not forgetting to take account of the fact that the shareholding itself is reduced. You have to take account of shares held by your spouse or civil partner in doing that. And the vendor must also not be connected with the company after the transaction, and that is basically more than 30% of the ordinary share capital. And again, you have to take account of the shareholdings of spouse and civil partners in that situation. So finally, the purchase of own shares must be undertaken for the benefit of the trade and not for tax avoidance reasons. And again, as we always say in this situation, that is 2 tests and not 1. But hopefully relatively straightforward. And again, it's one of those areas where you can apply for clearance for a purchase of own shares. And as with other clearances, can't recall if we've ever talked about this before. We have had a little bit of pushback recently on clearance for a lot of transactions. Purchase of own shares falls within that category as well. So you don't need to write, a huge long essay about the benefit for the trade, but there has clearly got to be a benefit for the trade. And often it is relatively easy if the person whose shares you are buying back is selling all of their shares. But if not, it can be more problematic. And going back to the company law point, company articles have got to give the ability to repurchase shares. Most new companies are going to have that, so that's not going to be an issue. Must be paying consideration in cash, can't be deferred, so you've got to pay it all up front, and you must have sufficient distributable reserves. Now, saying that it's got to be paid all up front, you can do delayed completion, which would be where you are you exchange for all of your shares on day 1 and then you complete in tranches. The first tranche has got to get you below 30%, and each time you've got to reduce it below 75%. So there are things that need to be done there. But let's just have a look at some examples of situations where this is or isn't problematic. So we've got 2 married couples who have the same shares. One couple have got one class of shares and the other couple have got another class of shares, but that in itself is not relevant because they gosh, I've completely lost my train of thought there, because sorry, all of the other rights are exactly the same. So Mr. and Mrs. L married, the wife wants to exit the company. So they're thinking of doing this by way of a purchase of own shares, but even if she sells all of her shares back to the company, her husband will still have 33% of the shares after the deal. So she is still going to be deemed to be connected with the company afterwards. So it's not going to qualify to meet the conditions due to the connection. So this was actually a case where we were trying to have a look at this. And the second proposal that we had was that the company should also then do a purchase of own shares of the husband's shares as well, a proportion of the husband's shares, to bring him down just below 30%. And then notionally, you meet the conditions. But the problem is that the repurchase of the wife's shares might be for the benefit of the trade, but is the repurchase of the husband's shares for the benefit of the trade? Because actually the only reason that you are purchasing the husband's shares is to bring his share percentage down so that the wife can get capital treatment. So it is for the benefit of the couple in relation to a reduced amount of tax payable, but it's not really for the benefit of the trade. And so clearance was not given in that particular case. Second example, company owned 100% by mother who wanted to pass it on to her daughter. So the idea was that they transfer a few shares to the daughter first, claim holdover relief, and then do a purchase of own shares. The idea was that the daughter gets 10% of the shares initially, company valued at around £800,000. Basically, the mother wanted to get all of that £800,000 out of the company. She was going to retain a very small percentage, but they needed around £250,000 to fund working capital. And so the question is, could you actually achieve that? So effectively, you could have purchase of the shares with the mother loaning the money back. But then you would have to make sure that she doesn't breach the 30% connection test, because it's 30% of shares, 30% of voting rights, 30% of assets available for distribution on a winding up. So if they strip all of the value out of the company and then she loans the money back, then chances are that she's going to have more than 30% of the assets on a winding up. And obviously you have to remember, if you're going to do this, is you do actually have to transfer the cash out. You can't do it by offset. Phased completion, we've talked about this already, where the mother transfers over a period of time. So let's just say there's 100 shares. She gives 10 to a daughter. And if we assume that the company is worth £850,000, that then means she wants to get around 700,000 of this out. Company wants to retain 250 initially, so she can get 470,000 out in the first round, which would be about 2/3 of the consideration. So she sells 60 of her shares back to the company in the first phase, but then she still owns 75% of the shares, which is more than 30%. So the numbers don't work out. Now, obviously, in that example, the obvious thing to do would be to gift more money to her daughter, gift her more shares to her daughter. But she wanted to be able to get as much money as possible out of the company as part of the share repurchase, which meant that, and this was actually a case where, in reality, we went round and round and round in circles, and the clients were just not prepared to be even vaguely flexible about this particular point, and therefore we just couldn't come to I think they did mackle something together in the end, but again, nobody was very happy, but that's often the way in these situations. If we go back to the benefit to trade test, as I said already, if we're talking about genuine succession planning, that shouldn't be an issue. But there is an issue if, again, the outgoing shareholder actually wants to retain shares in order to be able to get dividends out of the company. Even though the connection test is 30%, so that you've got to go below 30% in order to mean that you're not connected anymore, it is probably true to say that it is unlikely that HMRC would ever accept such a high retained figure. More likely that they're going to accept 5 to 10%. Now, I have had very heated discussions with clients who have basically said to me, Well, if it says 30%, then I'm going to keep 29%. Well, yes, that's just that test. And if you're keeping 29%, you've got to have a good reason why the sale of the rest of your shares is going to be for the benefit of the trade. And I'm not saying that you can never make that argument, but it does materially increase the risk of the revenue turning it down the higher the amount. Now, the other problem that we have is that typically the revenue would not expect anybody in this scenario to continue as a director. They will normally allow continued involvement as someone like a consultant, but they are typically not going to want them to continue as a director, which can cause some problems. If they are a consultant, then you can effectively argue that it is transitional support, some kind of overlap period to make sure that the new owners are successful, rather than ongoing detailed involvement. Although I have to say, it is very much often the case that there is quite detailed involvement, but it's whether the revenue would really think that's a problem, but you do need to make sure you're not too complacent about it. Now, it is sometimes simply not possible to get round the purchase of own shares problem. And so what you can sometimes do is structure it as a buyout rather than a purchase of own shares. So your children, we're still talking about succession planning here, set up a new company, they buy the shares from the outgoing shareholders. If the outgoing shareholders want to retain some shares, then you would do a share for share exchange for part of them. And then part of the consideration can be left outstanding as loan notes, which then means it can be paid out of the ongoing profits. Obviously, you need to meet all of the relevant conditions, one of which is that this is being done for bona fide commercial reasons. Now, that is a different test from the benefit to the trade test. You also have to be able to show that it's not for tax avoidance purposes, which is again the same as purchase of own shares, but it is much easier to make an argument that it is for commercial reasons, because of course succession planning is commercial reasons, but it does mean that this does seem to be more acceptable to HMRC, although that will depend on the facts. And again, HMRC can be suspicious if the retained shareholding is too high. I have seen a number of these where you can look at perhaps having 25%. And what the revenue will often say is that we're quite happy that this is for bona fide commercial reasons, as long as there is no intention for the outgoing shareholder to get control in the future. And I did have one recently where they wanted to do it by way of a buyout, where they wanted the parents, I think, between them to have 49% of the shares. And they also wanted to put in place some kind of option, which meant that they could get the shares back off their kids if they made a complete haulix of it. And not surprisingly, and as we said, the revenue simply wouldn't buy something like that. So I do think you have got to be, as is often the case with any kind of planning, is you do have to be realistic. It's like anything when you're talking about tax planning. I was having a conversation with a friend of mine who's got 3 kids, and she was talking about IHT planning, and see, I have very fascinating conversations with my friends. She was talking about IHT planning, and she basically was saying to me, well, I want to find a way where I leave, she's quite wealthy, where I leave these assets to my children, but I can continue to control them after I'm dead, because I basically don't trust them. And I said to her, well, you're going to be dead. Is it really going to matter that much? Anyway, we agreed to disagree in the end. Okay, we've already mentioned that with non-trading businesses, it's quite problematic. And probably the only options that you've got are to do with growth shares, where you have a new issue of shares to say the parents, where they don't have any current value, but they will participate in growth going forward. And as I've already said, it can be quite difficult to, restrict existing value. But again, it's just something that you've got to do. Now, this does bring us on quite neatly to family investment companies. Now, family investment company is the sort of generic name. It's not an official type of company. It is just the generic name that is given to a company which has different family members as shareholders, and where you accumulate cash in that business and then use it to invest. And sometimes you will have some shares in the trading company so that you can get dividend income out of the trading company. And sometimes that is done, for example, by issuing a new class of shares to a family investment company. I have to say that I do think family investment companies work very well. I do think that there are situations, however, where family investment companies are used in a way which means that they are quite risky. And I do think, and I know that the Revenue looked at family investment companies probably about 2 years ago, and then sort of said, well, we do think most of them are being used for legitimate purposes, but we're going to keep it under review. So we've kind of had one stay of execution as far as that goes. But I do think that there are some issues that we just need to be a little bit careful about, really. So, again, it is possible to use something like a family investment company, but again, it's one of those things that's quite difficult to make generic comments about, because there are lots and lots of different variations in relation to family investors and investment companies. So, but it is certainly something that you can play around with. Sometimes there are situations where you have got succession with family members where we need to have a little bit of creativity, I suppose, in relation to how succession is managed. Perhaps initially taking advantage of holdover relief, but then looking at doing some kind of further reconstructions. Now, this is very much dependent on individual situations, but I thought it might be quite useful to look at an example that we had, or that I had, which sort of looks at some of the possibilities. So we had this chap who had 2 companies. He had a parent company with 2 subsidiaries. And the parent company owned the property from which the subsidiary companies traded. So that was fairly straightforward. And he had 3 sons. Now, the 2 companies that he had were engineering companies. They were engineering companies within a business sector which is going to diminish due to climate change and various other things. Can't really say a great deal without wanting to, maintain the anonymity of my client. But those 3 sons really did not want to be involved in those 2 subsidiary companies because they were a bit messy, a bit dirty. They fancied themselves as being a little bit cut above their dad. The dad was a lovely client, not so convinced about the sons, to be honest with you. But anyway, they didn't want to get involved in these companies. They quite fancied getting into sort of property development and property investment and so on. And so what they basically wanted to do was to have the dad owning the to subsidiary companies, and the boys having the property, so that whilst the trade continued, the trading, that was all well and good, but at the point at which the trade eventually was wound up, the boys would then be left with their property, and effectively they could then develop it either to sell or to rent out. So what we did first was transferred some shares in the top co to each of the boys. So we had a holding company which had all 4 of them as shareholders. So what we're attempting to do here is to do some kind of reconstruction which enables the aims to be met, or at very least partially met, mitigate some of the IHT liability that was going to arise to the dad if he ceased trading and then ended up with assets that were not covered by BPR, transfer some of these assets into the hands of the boys, and then, you know, effectively deal with that. We then put a new holding company above the existing company, and put the other company as a direct subsidiary of the new holding company. So we were left with a holding company, 3 subsidiaries underneath it, 2 trading companies, and 1 property company. We then partitioned the shares in the holding company so that the boys had B shares and the dad had a mixture of A and B shares. The A shares had the rights to the income and assets from the 2 trading companies, and the B shares had the income and assets from the holding company. We then did a liquidation demerger where we distributed the shares in the trading company out to the dad and the shares in the property company out to him and his sons. Now, that achieved part of what we wanted. The clients wanted the whole of the property in the hands of his sons, but I didn't think that you would get clearance if you were going to do that completely. So because there were share for share exchanges and then there were demergers, we had to get revenue clearance for this. And I have to say that the revenue did haul us over the coals a little bit about various things. So they were basically saying, well, why are you doing this? You know, why are you not just splitting out the companies? You know, why are you not just saying you're giving boys shares in this company? But we were quite lucky in this situation because there's quite a lot of risks involved in the winding up of these businesses. And so we wanted to get the properties out of the group to ring fence them. And so there were various commercial reasons why I think we were able to, you know, effectively get clearance. And we did, this was at a time after the sort of the new stricter clearance regime. So this wasn't, you know, 10 years ago when it was actually quite straightforward. As I say, my feeling was that effectively, if you had a situation where the dad had not been a shareholder in the other company, it would have been harder to get clearance. Obviously, it is a demerger. There is other compliance that needs to be done. They would need to make sure that the company that have been demerged weren't sold or wound up within a period of time. So it was, but anyway, the revenue did give us clearance, and that transaction has taken place now. The trade is being wound down, and effectively that is now, they are now doing what they want to do. Are there typical timescales for obtaining clearance from HMRC? Well, HMRC have got a 30-day turnaround period. Now, the slight problem we have is that if the revenue write and ask you for more details, the 30-day period starts from the date at which you reply to them again. And it's a slightly cynical view, and I've got absolutely no evidence to back this up. But I have had a couple of cases fairly recently where sort of day 28 or 29, we get a letter from the revenue asking what feel like fairly spurious questions. And so I do wonder, but I think that my understanding of the way that the clearance section works is that they have someone who is fairly untechnical reviewing the clearance applications as they come in for certain sort of, just trying to think of the word, certain criteria, which means that they are deemed as relatively high risk, so that they are passed over to a higher level inspector officer. And those, I think, would probably take longer. And complex transactions, this will have been dealt with by somebody looking at complex transactions. Everything else kind of gets parceled across to someone who is just basically checking it. But ultimately, those straightforward ones often get turned around quite quickly. So it's a very long-winded way of saying that, you know, they have supposedly got to respond within 30 days. The nice thing about clearance applications, I say the nice thing, the convenient thing about clearance applications is that you can send them by email, although you do have to put that disclaimer on the email to say that you're quite happy to run the risk of email. But because it's done by email, obviously you don't wait a long time for the response to come back. So I think that is, you know, just I would always do these things by email if you are happy to take the risks involved in that. So sometimes I think when you're talking about succession planning, as I say, when you are moving, if you are moving from being a trading company to an investment business, there is always that window of opportunity when you can transfer shares at a time when it is still a trading company, and before you start to move inexorably towards it being an investment company, when you do have that real opportunity to think about what you are going to be doing going forward. And it's just catching that at a point where, you know, you can convince the clients that it's the right thing to do. Okay. Obviously, if you are passing assets over on death, then from a business perspective, then you are looking at the availability of BPR and APR, business property relief and agricultural property relief. This is, of course, also relevant if you are gifting during your lifetime, because if you die within 7 years, there may well also be a need to consider whether or not BPR or APR are available, as the value would otherwise come back into the estate. Obviously, if you do give on death, you get that tax-free uplift for CGT purposes, so that any ongoing sale will have a reduced tax liability. And in reality, that is why people often think that they are better off giving assets on death rather than giving them in lifetime. But particularly when you are looking at sort of general trading, doing that on death can be problematic in some situations. Just very quickly, talking about business property relief and agricultural property relief, I'm not going to talk about these in any great detail because there are other issues that I want to cover. Running out of time, as always. If you have qualified business property, BPR is automatic, although it's only notionally automatic because you do still have to put it on the IHT return. You can get BPR on assets anywhere in the world, assuming that they qualify and assuming that you have held them for 2 years. There is something called excluded property, which is very broadly where you have got investment businesses. But you also have to be very careful when you are looking at the valuation of assets which in principle qualify for BPR, that you don't have accepted assets. And as I said earlier on, one of the big issues that we've got with the revenue at the moment is looking at cash accumulations within companies. And the case that I've got working on this particular point, the revenue are taking a very strict point here. Basically, if you've got cash in your company, you have got to demonstrate that it is required for the purposes of the trade in the next 2 years. And the company that I've got is one where the shareholders of the company owned the business premises outside of the company. Because when they bought the business premises, that was the only way that they could finance it. But the intention always was that when the cash came into the business, that they would buy the property off the individuals who bought it and get it into the company. And they accumulated a certain amount of cash in the company that they were going to do this with. And then the main shareholder, so the mum and dad were the shareholders of the company. The main shareholder got motor neuron disease, and the wife got cancer, and they both died within a 4-year period. I think the dad died after about 2.5 years, and the mother survived in about 18 months. And the daughter and her husband took over the business. They had no real knowledge of running the business, and so it was all a bit touch and go. And then as soon as the mother died and they got probate, they enacted they purchased the property out of the estate. And the revenue are basically saying, well, you know, why is it taking you 5 years to buy this property? And the answer is, well, because one of the directors, one of the shareholders had motor neuron disease, the other had cancer. The two people who were actually running the business didn't really know what they were doing, and obviously they were dealing with the parents' illness as well. They wanted to keep the money in the company in case everything went a bit pear-shaped, and that to me seems like a very reasonable fact about this all, but they're saying no. So we've got some way to go with that argument yet, though, I think. Agricultural property relief is available on property used for the purposes of agriculture, but only up to agricultural value. Need to be a little bit careful if you have got land which has got value above agricultural value. If you are actually trading on the land, then the agricultural value may be higher than that. Sorry, the agricultural value will be covered by APR, but the higher up value will be covered by BPR. The real problem you have is where you're getting APR because you're renting the property out. And that means that you only get agricultural value up to a certain value, and BPR would not be available beyond that. Interesting question a couple of weeks ago from someone who has got farmland which is rented out, so would be eligible for APR, but they have just granted a license to somebody which would enable them to mine under their land if they wanted to do so at any point in the next 25 years, because there are minerals under the surface. And if the revenue in that situation wanted to argue that the value of the land was higher than agricultural, which they might be able to do even if the mining hasn't started, then they are going to have some problems. So agricultural assets anywhere within the United Kingdom, so it's only within the United Kingdom now, not within any large area. Agricultural property, land, farmhouses, as long as they're of a character appropriate, and any other buildings used in the trade. So again, hopefully fairly straightforward. So it's really holdover relief, purchase of own shares, something like that. buyouts in lifetime, gifting on death, BPR, APR, and so on. Let's move on and talk about passing on to employees. The idea that you pass a business on to the employees often seems like quite a nice idea. And again, transfer of shares to the employees and then perhaps purchase of own shares to get cash out, MBO, management buyout, if you're looking at something a bit more comprehensive. But the bottom line is that the biggest problem that you have when we are talking about any kind of situation where you are going to see shares effectively ending up in the hands of employees is employment-related securities provisions. Now, a long time ago, HMRC did accept that you could have an MBO where the shares issued were not employment-related securities, but I think it's probably 20 years since they've accepted that. Shares are employment-related securities where they are provided by virtue of the employment. And there is a deeming provision which basically says if your employer gives you shares, then they are treated as obtained by virtue of your employment. So it makes structuring of these things incredibly difficult. So in broad terms, employment-related securities follow the general principles of taxation as confirmed in case law, which basically says you look at the difference between the market value of those shares and the price paid, and tax and income tax charge arises on the difference between those two figures. The problem is, however, that simplifies it down to a point where in reality that does not adequately express the position, because where we have a situation by where we're saying, okay, it's the difference between this and this which is taxable, if you can reduce the market value, then you reduce the tax charge. And so there are, in many ways, too many ways in which you can manipulate the value, which means that there are pages and pages of anti-avoidance provisions. Now, most of these are seen fairly rarely. The one that is most likely to be seen is restricted securities, so I will look at those on the next page. But you also have convertible securities, so where you issue somebody shares with a very low value because of the nature of the shares, but they are convertible into something which will inevitably be more expensive. Shares which have been artificially suppressed in value, shares which are then artificially enhanced in value, shares acquired at less than market value not caught by the general provisions, which used to apply to people who are not resident, but doesn't really anymore. Securities disposed of for more than market value, post-acquisition benefits received in relation to employment-related securities. That one, securities disposed of for more than market value, might be something that you do see. Sometimes you will see a situation where somebody has a very, very small number of shares in a company in order to reduce the income tax charge up front. But actually, there is a side agreement which says if the company is ever sold that they're going to get more. So the main shareholder agrees that, you know, maybe somebody's got 0.5% of the shares in a company, but they agree that if the company is ever sold, they'll receive 5% of the consideration. That would be taxed to income tax as well. But the one where we see the most securities is, the most problems is in relation to restricted securities, because the easiest way to reduce the market value of shares is to restrict the rights associated with those shares, or alternatively make them subject to forfeiture. Now, one of the things that's quite difficult about this legislation is that you may well be restricting the rights of these shares for a commercial reason. Because if you have an idea that somebody is going to be your successor, and what you think of is, well, okay, I'll initially give him some shares in the company, just see the measure of the man or woman, of course, And then we'll see how it goes. You might think, well, but you know what, if he decides that this is too much for him and he panics and leaves, I want to get my shares back. And you might put, say, a 3-year carve out on those shares on the basis that you give someone shares, but if they leave within 3 years, you want the shares back. So that would be a valid commercial decision, but it would still make them restricted securities. So, and it will apply in most situations, whether you are just giving shares to somebody as a possibility that in the future they can take over, or you've got something much more aggressive like an MBO. So the specific types of restrictions are where there is a restriction on the transfer, reversion, or forfeiture. So you transfer, forfeiture, or reversion of ERS on a specific event, or where there's any restriction on your ability to dispose of the shares, or any other restriction which reduces the value. Now, the tax implications of this are complicated. The first thing to say is that if the restrictions are lifted within 5 years, there might not be an initial tax charge, but actually that would mean that there is a tax charge when the restrictions are lifted. But basically, if you have got restricted securities, your initial tax charge is based on the difference between the restricted market value and the price that is paid. But then if in the future you either sell the shares with those restrictions still intact, or those restrictions are removed, you have an income tax charge in the future, rather than the whole of the increase in value of the shares being subject to capital gains tax. Chargeable events are shares ceasing to be restricted either wholly or partially, or selling the shares while they're still restricted. And the tax charge is very, very complicated, but can be simplified down to a fairly straightforward one. So if you have got shares that have got a restricted value of £1, and you pay £1 for them so that there's no upfront tax charge, but the unrestricted market value would be £3, then 2/3 of the value of that unrestricted share has not been taxed, which means that if you sell them in the future for £10, 2/3 of that £10 value, so £6.66, would be subject to income tax, and only the balance would be subject to capital gains. But what you can do is elect to treat the shares as if they are unrestricted. So in that previous example, you would effectively accelerate the tax charge so that you pay £2 up front, but then you reduce the amount that you might pay in the future. And typically that would be what you would do. Election has to be made within 14 days, although you don't have to submit it to HMRC. The big problem that you have is that if the value of the shares goes down, you don't get the tax back. To be honest with you, the biggest issue that I see when we are looking at planning is simply the tax charge which is going to arise where shares are given to employees. So I have been advising on a case where we had 2 individuals set up a company. It's a startup business. There was a 3rd person involved, and that 3rd person was told that they would get 10% share in the company, but he didn't want 10% of the shares when the company was first set up because he was going through a divorce, and he didn't want his wife to get her hands on any value, although I don't quite know what the situation was, because at the point that the company started up, I wouldn't have thought there would be any value anyway. So we're now sort of rolling forward a number of years, and they're just trying to sort out this 10% of shares to go to this guy. And the company is now worth, I don't know, a couple of £1 million. And so 10% of shares, even with discounting, is probably going to be worth, you know, quite a big wedge of money. Now, there are two issues here. Because one of the shareholders was going to gift his shares or some shares to this individual. But this chap who they are gifting the shares to actually lives in America. So if this chap gifts shares to this other bloke, he's not going to get holdover relief on them because the recipient, the donee, is non-resident. So if the company issues shares to this chap, they will be employment-related securities, and he is going to have a massive tax charge. And he's basically just saying, well, we're not going to do it then, but you owe me this money. It's got very, very messy in the end because there's no way of getting around it. Now, I've had another conference call this week on a similar situation where someone has been promised shares in a company, but what we're going to do is put in place growth shares, so that only the future growth of the company is going to attach to these shares. So we can basically argue that they have no value now. Now that is going to work because even though it's a relatively new company, it's only worth about £200,000. The guy doesn't want to trigger a tax liability now, which I can understand entirely, even though it would be relatively small. But at the end of the day, he is quite happy to forego that £200,000 worth of value so that he doesn't have a tax charge up front. So we can get around it in that situation, but you often can't get around it. So it is often that initial point where you're trying to get shares to someone. I am going to run out of time, but just to mention that sometimes with employees, you could use something like an employee ownership trust, which is effectively where you transfer your business to a trust, but then no single individual is going to own that company. And there are various ways of doing it. From the perspective of the business owner, if you transfer your shares into an employee ownership trust, there's no gain, which means that it can be, for example, a good alternative when there's no business asset disposal relief, although, as the slide says, to be honest with you, that is very rarely a motivation. You have got to give away a controlling interest, which may not mean it is attractive. It's also exempt from inheritance tax, and you can be paid for your shares. You can then have the trust distribute bonuses of up to £3,600 per employee, which can be distributed tax-free. I often find that when you start to talk to people about employee ownership trusts, they don't really like them as an idea, but they are something that are worth looking at. Now, we have come to the end of this session, just to mention, of course, that if there is no obvious successor to the business, then you might be looking at a sale. If you're looking at a sale, you might well be looking at business asset disposal relief. And although sometimes that is not relevant because the amounts involved are too big, I'm not going to talk about it here because we've talked about it at length before. Obviously, just remember that you have got to be able to meet the conditions and make sure that you meet those conditions. So, again, I think that is relatively straightforward. Okay, that brings us to the end of this session. Thank you very much for your time today. I hope that you have found this useful. And as Marie said at the beginning, please do enjoy the weekend. Weather doesn't look like it's going to be very good, but I'm going to a big concert on Sunday and the weather looks awful, but hey, it's an outing out. And then I've got a friend who's organising a country fair on Monday, which I should be going to. I think I should just get my wellies out and just my coat and I'll get on with it. But anyway, thank you very much for your time today. And I will see you in due course. Thank you and goodbye.